Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As I said, it keeps you open and flexible. By building those alternative scenarios based on the fundamentals that you see, you don't get locked in or fall in love with a position. Even though we say this, I've done it. I still tend to do it. I tend to overstay a belief that I have. But building plausible alternatives allows you trying to move away from that. We've all fallen in love with our own story and have stayed too long. I've gotten really absolutely smacked. And that's the problem by only thinking of one thing, one driver. This has to be the reason the currency is going south. This has to be it. Everybody believes this is it. Well, it may be another reason, but if you're thinking one way, you're going to tend to be blindsided. You're not going to be open to negative information that's going to invalidate your current view. By staying flexible, you can stay open to pieces of information. It's just one of those human nature things. If you're flexible, you're going to stay open to constant information flow that'll make you more aware of what's going on instead of being, trying to fight the market or believing you're always going to be right. And that's what this alternative analysis using the fundamentals does for you, I think, in a very big way. And as I said, obviously it allows you to position ahead of the crowd because you can see things that are starting to play out and start to make sense. So that's going to give you confidence to start moving in the other direction where others may, wait and stay with it too long, and whack. And that's the general nature of the market. If we had to look at a standard price action in a market, there's the first move down, there's the early adopters that are in saying fundamentals have changed, then we have a second move down that tests, all right, and says, okay, we're still in a bear market, but doesn't make it. And then we see that powerful, leg here. Kind of this is like a Dow theory or a third leg up. This is where the public, starts to get involved, right in here in a big way and drives the moves. Then we have another test, and we have a move back up, and this little test adds confidence to everybody. This has to continue to go. Starts to come back again, and everybody buys that dip right there again, and then they're feeling good. Doesn't make a new high, and whack, everybody's whacked. That's a general boom bust cycle in the market that very much ties with human nature. But if you start to, and as I said earlier, if you start to evaluate the fundamentals, they really come into play at the ends of these things and allow you to avoid some of these sometimes and get in early over here sometimes because of the fundamentals and not the pure technicals and not being caught up in just the current story or the current rationale, and that's where I think they help you in a very big way, especially in the currency markets, because the currency markets in general are so sentiment driven. They're sentiment driven because if you think about it, just think about all the different fundamentals that can come into play in currencies. And you don't really have an income statement or a balance sheet to analyze the currency like you have in the stock market, or to analyze a bond. You know what your cash flows are going to be. You know the credit risk of the issuer of the bond. You know what the inflation rate is. So you can make a pretty good guesstimate there. Obviously things change. But when it comes to currencies, you have domestic policy, international policy, you have politics, you have global economics, you have socioeconomics, you have outside events, war, weather, all those things, and the potential variables are really huge, and that's why it creates a confusion. That confusion leads to sentiment trends where people tend to boil in on one rationale, whether it's right or wrong, and that builds sentiment. And that's why you get these self-reinforcing trends that move more in the currency markets than you see in the other markets. No doubt stocks will extend beyond their fundamentals and come back, but not to the degree, at least historically, not to the degree that currencies do, because of the fundamentals are somewhat confusing to latch onto. So what are the important things to think about in terms of the fundamentals? Well, you're really thinking these two things really are ultimately the things you can hang your hat on. We can talk about budget deficits and current account deficits. We can talk about what's going on in the Middle East and this and that. But in reality, over the intermediate to longer term trend, these are always the things that have worked in the currency markets. And it's interest rates. The current value of the current level of interest rates is one. The expectation of where the interest rate is going to go is two. The current yield, the yield differentials between the currency and another currency is important. Let me give you an example. One of the reasons the Australian dollar is so hot right now is the fact that its yield is much higher relative to the U.S. dollar. It's because its yield is about 3.5% range, I guess, where their benchmark rates are. Ours are 0, or 0.1% on the low end. So you have almost a 3.5% yield differential right off the bat in the Australian dollar. Money likes to move where the highest yield is. There's a lot of hot money around the globe that moves purely on yield differentials. So on that measure alone, the Australian dollar beats the U.S. We also know the Australian economy is growing faster than the U.S. economy, so it beats it on an economic growth front. We also know that the central bank in Australia has hiked rates, and now they're making noise. They may hike rates again. So the yield differential is not only already 3.5%, but could grow. So these things we know that are powerful drivers that tend to pull money into a currency relative to another. And those differences right now between a currency like the Australian dollar and the U.S. dollar are very stark. One that's a little further out there and towards the emerging world, or at least the developing country world, is Brazil. Brazil's short-term interest rates, 8%, 9%, I think, range. A little over 8%, I guess it is, on the front end. So you get an 8% differential right away, and Brazil's supposed to grow at maybe 4.5% next year. U.S. will be lucky if we, scrape by with 2%, I think. So those are some drivers right there. Those are the types of fundamentals that tend to move money in a very, very big way. And those are the ones, again, over the intermediate term trend you can hang your hat on. No doubt, from a short-term trading perspective, you're going to get a lot of volatility, a lot of randomness, and those things that we talked about, politics and outside events, will hit currencies intraday or multi-week type of thing. But in general, the fundamentals that are playing out over time are what drive the longer-term trends. I don't have the chart here, but even if you step back and look at the long-term chart from 1971 when the currency market started trading, I say that if you just briefly explain that, before 1971, currencies were pegged or fixed. They were pegged against the U.S. dollar. After Bretton Woods, they were in that Bretton Woods system, and you could exchange in that proportion for gold. So it was really a dollar gold-based system, but currencies were fixed. In 1971, the gold standard went away, Nixon took us off, and currencies started to float. So from that point on, 1971 on, currencies started to trade on basically their fundamental values. And how was their fundamental value defined in the marketplace? It was defined by the flow of capital, supply and demand. All the investors around the world started voting on the currencies, on the country's fundamentals by supply and demand. If they liked the currency, they moved money into that market. Hot money went into deposits. Longer-term money came in, foreign direct investment, to get access to the growth, the economic growth side. So they're always looking at the fundamentals to make those decisions, the big portfolio flows. Obviously, the shorter hot money stuff is very much tied to yield differentials. But those ultimately are the drivers over time that we can always hang our hat on if you look. The point I was going to make, sorry, I almost missed it. If you look back at the long-term trends, the monthly trends, you can always see major global macro events that have changed the fundamental balance in the global economy, that have launched the dollar into major bull and bear markets. We've had two major bull markets in the dollar, three major bear markets. We're in the midst of either the third major bear market we're still in the midst of, or it ended in March of 2008 where the dollar made its old low.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.